So we've covered already how we're going to define this output benchmark in terms of creating our model that relates output and price changes. We're well on our way to getting to these aggregate demand, aggregate supply lines here, but while we've defined this horizontal axis, we have yet to define this vertical axis, which in textbooks is usually a price level or an inflation measure. So in this case, we will use an inflation gap. So to build an inflation gap, first of all, we need inflation. Well, what is inflation? It's the growth of an overall measure of all the prices in the economy. We take all of the potential goods and services that are within the economy and we put them all into a basket and put a certain price level to it. Now, the level of this price doesn't really matter so much as the growth rate. That's, again, what we really want to look at is this inflation rate, which traditionally in economics is denoted as pi, or a little p, for prices. This is not pi as in 3.14159 in the mathematical sense, but it is the growth rate, like the little y of the big Y. This is the growth rate, little p, of these prices. And that's what we're going to be putting, well, part of what we'll be putting on the vertical axis. What we want then is this growth rate in prices relative to a benchmark. So, all right. Let's take a look at the various measures of inflation. We can use the GDP deflator, which what that does is uses the GDP measure itself to estimate a real price in the economy. We can use the consumer price index. That's a very popular one that we see in the news media. The producer price index, less popular and more volatile, but this is like a measure of the prices that producers face when they're buying certain inputs into their production. Or we can use what the Federal Reserve uses, which is what I will focus on, the Personal Consumption Expenditures Price Index. So that's looking more specifically at household consumption. And that's really the favored metric of the Federal Reserve. So that is what we'll do, because we want to tell what's the Fed going to do. Well, if we want to tell what they're going to do, we got to look at what they are looking at. All right, so then what we want is an inflation gap measure of this PCE, Personal Consumption Expenditure Rate of Inflation. And what we'll use as a benchmark is an arbitrary measure of 2%. Why 2%? Because that's what the Federal Reserve uses. Why does the Federal Reserve use 2%? Because the Bank of New Zealand used 2%. And this, turtles all the way down kind of argument. But 2% is apparently agreed upon to be this constant good measure or good level of inflation to get to, this good growth rate of the prices. I don't think it matters necessarily whether it's 2 or 4% so long as people expect it. So long as the Fed is transparent, and we're targeting 2% right now, and you are to expect 2% when you're making your contracts in terms of wages or potential purchases down the future. So this inflation gap is then measuring a bit of our expectations in what we see of inflation. So if everybody is supposed to be expecting 2%, and let's say it comes in at 3%, well, what's the consequence of that? Or if it comes in at 1%, what's the consequence of that? Now this, again, it's a sticky area to be into, but bear with me. So inflation is only really high or low relative to this target. I mean, if we're expecting 20% inflation, then, is 30% really all that high? It matters in this benchmark. The Federal Reserve wants to benchmark people's expectations to this 2% measure. On-target inflation is supposed to be good in that it provides a stability for contract making, a stability for anticipating what these price changes will be, and that's within the Federal Reserve's mandate of price stability, right? So they're going to target this 2% inflation. Now, if we get off of this target, the potential consequences could be a purchasing power redistribution. If my wages rise slowly, then I'm going to feel the effects of higher than normal inflation more distinctly than, say, someone who's working in the tech industry whose wages can rise fairly quickly. There are also these menu costs that firms will face in terms of they have to put in time and effort into following these prices and changing these prices, or potentially facing a punishment by consumers if they raise prices too fast. So there are these menu costs that firms have to take into account. And of course, long-term contract making is affected if inflation is higher or lower than the expectation. All right, so when we build this model, notice here the aggregate demand curve is showing a negative correlation. It's gray, so you can kind of see it, but we'll get to that. A negative correlation between these prices and these real outputs. A positive correlation in the short run between these prices and outputs, and then no relationship in the long run curve. So how does that work out? I mean, this seems kind of strange, but it's not all that strange because you have to consider how different agents are going to react to these price changes. Producers will react differently from consumers in terms of these price changes. That's why we're distinguishing between this aggregate demand and aggregate supply and how they relate to inflation rates. And finally, what we want to do, if the Fed is operating under the what's called the Taylor rule, and they're trying to fulfill their dual mandate of stable prices and maximum employment, what we will end up seeing is inflation having this very significant effect on how the Federal Reserve chooses its short-term interest rate. So that's the importance of the inflation gap and how we're going to put that together in the AS/AD model. We're now ready to move on to some of the other curves and how those are put together.